Hi gang, today we're diving into something that impacts every single one of us in the United States, namely, what is going on with the credit reporting bureaus and where they're heading next. For decades, the big three, Experian, Equifax, and TransUnion, have controlled the data that ultimately decides your financial future. Your ability to buy a car, to get a mortgage, even a 50-year one, or qualify for a job is all tied to these reports. But that system is actually starting to change. The first big shift we're seeing comes from buy now, pay later. Until now, the short-term repayment plans didn't really fit in the traditional credit system. You buy something, you pay it off in a couple of months, and then those payments often never showed up on your credit report. Now, the credit bureaus are really trying to figure out how to cram that data in. And it's not just about tracking debt or new derogatories if you miss a payment, although that is definitely a part of it. It's ideally about giving consumers a more accurate chance to prove that they can handle credit responsibly. The goal for credit reporting should be simple. If you're paying responsibly, it should count for something. But here's where things ultimately get tricky. The credit bureaus aren't really working for you independently. They're paid by banks and lenders who buy their data. So when you file a dispute, when you say, hey, hold on a second, there's something wrong with my credit report, you're essentially asking the middleman, who's funded by the other side, to fix it for you. That's why so many people feel like the bureaus aren't ultimately on their team. Because in many ways, they're not. There is the Fair Credit Reporting Act that gives you the right to dispute errors, but that process is slow and confusing, and let's be honest, kind of unfair. Some experts say what we really need is one national credit bureau, a central database that all lenders would be required to report to. Many other countries already do this, and it would make reporting more accurate and hopefully more fair for everyone. But right now, the US reporting system is a give-to-get type model. Lenders pay the bureaus to access credit data, so in return, they're supposed to report their own data back. But not every lender reports to all three bureaus, which means your credit profile could look strong with one bureau and totally incomplete with another. And that can definitely hurt you, because if your positive accounts aren't showing up everywhere, well, then you're not really getting the full credit that you've earned. Another big change that's currently happening is that Fannie Mae has thrown out the use of a credit score. It used to be, let's say you had like $200,000 as like your income for a year, you got 50 grand in the bank, but you go for a Fannie Mae loan and you've got like a 600 credit score. Even with all that going for you, they'd still tell you to kick rocks. Now, Fannie Mae is saying, look, if you've got all the other credentials figured out, forget the credit score, it's fine. That's huge. That's a huge indicator that the judgment, the behaviors, the thought process towards the credit score right now in America is currently in flux. But let's talk about the scoring models themselves. So you've obviously heard of FICO. That's the gold standard. That's the one that's been used for decades by banks and mortgage lenders. But there's actually another player in the mix that's been gaining momentum, VantageScore. It was designed to make scoring more consistent across all three bureaus. In theory, if every lender reports the same information, well, then your VantageScore should look the same everywhere. But in reality, small differences in reporting create vastly different scores for individuals. Still, more and more lenders are starting to use VantageScore. And so within the next 5 to 10 years, experts predict it could be nearly equal in market share with the traditional FICO score. FICO, meanwhile, is testing a new system that bypasses the credit bureaus entirely for certain industries, like mortgages. So instead of pulling your score through a bureau, lenders could now license it directly from FICO. If that expands, it could completely change how credit scores are distributed, priced, and updated. Now here's where things start to get exciting and hopefully a little more fair. There's actually a growing movement to include alternative data in credit reporting. Think about it. Your rent, your phone bill, your Netflix subscriptions. These are regular on-time payments that show a certain level of financial responsibility. But right now, most of them don't count towards your credit score. Now, rent reporting could be the biggest market shift of the bunch. Paying rent on time every month is a great indicator that someone can manage a major expense. Yet for most people, it does nothing to build their credit. So if lawmakers could actually come together for a minute and make rent reporting mandatory, millions of people could see their scores go up overnight. Now there's actually a couple of products that are sort of connecting these dots. Self is a service that will report your rent as a positive account each month. And Built is a card underwritten by Wells Fargo that reports your mortgage payment as a positive credit payment, and then you can pay back the card at your leisure any time of the month. But these are third-party ideas to solve a problem that the institution should be doing itself. Now here's another issue that doesn't get talked about enough: credit education. Most of the advice out there from the bureaus themselves is obvious. Oh, make sure to pay your bills on time and always keep your credit utilization low.
Yeah, no kidding.
But that's not really education. Real financial literacy means understanding how the system works behind the scenes. It means knowing that you need at least 3 revolving credit lines, an installment loan, and clean, error-free reports to get the maximum out of your credit. In fact, financial literacy is one of the things that Fund&Grow is most passionate about, whether that be personal or business, which is an entirely different ball of wax. But if you're feeling lost, if you're feeling stuck where your business isn't scaling or launching like you want, or you don't even really know where to go with your credit, click the link in the description and let's schedule some time to discuss your credit and come up with a plan to help you reach your goals. But back to the point, where is all this heading? Well, over the next few years, we are going to eventually see real-time credit reporting. Buy now, pay later accounts are going to start showing up on your reports. Some of them already are. Rent and subscription data are going to become more common reflectors on credit as well. And lenders are going to begin using transaction level data, meaning how and where you spend your money could shape your future credit worthiness. It's an evolution towards something more accurate and hopefully something more fair, because your credit score should reflect your full financial story, not just what the bureaus decide to include. Now, if you found this video helpful, hit that like button, subscribe for more insights on credit and finance, and let me know in the comments, what change would you most like to see in the credit reporting system? For everybody here, I'm Zach Ritchie. Thank you so much for watching, and we'll see you in the next video.